Hey everyone, welcome to our Asset Management Friday segment of the Passive Income Through Multifamily Real Estate podcast. I am your co-host, Kyle Mitchell, also joined by Gary Lipsky. This is a new segment that we recently launched. It's focused on educating operators, building better systems, and becoming a best-in-class operator. Since we're also live on Facebook right now, make sure to type in any questions you have in the comments section. Also, be sure to check out our Facebook group, Passive Income Through Multifamily Real Estate. All right, today on the show, we have Greg Dickerson. Greg, welcome, and thanks for being on the show.
Hey, it's good to be here. Thanks for having me.
Awesome. If you could please tell the listeners a little bit more about yourself and what you currently do.
Yeah, so I'm a real estate developer. I've been in the business since 1997, started as a remodeling contractor, built that into a $30 million company in 7 years and sold it, started 12 other companies along the way. And my whole philosophy has been build businesses that generate cash flow to invest in other assets. So for me, that was real estate, into commercial real estate, into land development, into bigger projects. So 23-year career, done a little bit of everything, and I'm currently based out of Charlottesville, Virginia, and I focus on the Southeast from DC all the way down into North Carolina.
Excellent. So Greg, today we're going to talk about due diligence. This is a meaty question, but kind of walk me through your step-by-step, everything you do for due diligence, who's involved, when do they get involved?
Yep. So due diligence starts when I am doing underwriting and asset evaluation. So I start with all of the documentation. So you want all of the financials, you want all the rent rolls, you want all of the environmental surveys, what's called an ALTA survey, any appraisals that they may have, bank statements, whatever you can get documentation. And the brokers are pretty good these days with gathering documentation, especially on larger assets. So I start with that. And then I start looking deep into the surrounding area of the property. So what does the property look like? What is the surrounding area? What types of businesses are around the property? What do the vehicles look like? What does the traffic look like? I like to visit the property at different hours on different days. So that property can look very differently on a Monday at 2 o'clock than it will look on a Friday night at 6 o'clock, or a Saturday afternoon or morning at 10, 11, So you want to visit the property multiple times, different hours of the day, and kind of see what's going on. Look at the tenant mix, look at what kind of cars are there. So that's where I start with the due diligence from a financial standpoint, from the paperwork and things like that. Once I'm on site and I'm doing a property visit, kind of the same thing. I like to drive around the block, look at what the competing properties are. What are the vacancies? Are there for rent signs up everywhere? That kind of thing, and just kind of look at the general area within a 1 to 3 mile radius. Of course, I've done all of that online as well, looking at rent comps, things like that. I read the reviews. What do they say about that? What do they say about the other properties around it? Things like that, and do those comparisons. And then I've got some analysis software that kind of shows you averages across the country of different things that I use. But then when I get to the site, I like to go through the property, drive through it, and then start noticing everything, from the ground up. So I look at the parking lot, the curbs, the sidewalks, what does the landscaping look like? What do the amenities of the facility of the property look like? What do the vehicles in the property look like? What do the tenants look like? Then I start looking at the building. What does the foundation look like? What is the bottom of the foundation where siding hits the slab? Is it on a crawl space? Is it on a podium, pedestal? What kind of structure is it? So I'll look at that. What do the windows and doors look like? What do the heat pumps look like? Utility connections, things like that. So I take a real deep look at it. I don't get up on the roof myself, but I look at it from, the ground and distances. So I can kind of get an idea of that and try to assess the overall condition of the property. And then in this current environment, you can't get into the units. I like to get into every single door in every single room. So even if you're in a unit or in an office, especially, you want to look behind every door, find out what's going on, and see if those units are occupied, if they're giving you, accurate economic occupancy information and numbers, and then visit each unit. So in a nutshell, that's the wrap of what we've got going on. Now, when you add the coronavirus in there, and especially as we start moving forward, further down the line with this, you're going to want to verify economic occupancy. You're going to want to have an honest conversation with the owner. How many of your tenants are behind? What kind of jobs do they have? Where do they work? Those types of things. And you want to try to anticipate loss of income because it's going to be there. So if you're underwriting, I like to underwrite 10% vacancy. I'm very conservative. I never do less than 10% vacancy. And then I always make sure that I've got and this is before all this happened, I always make sure that I've got about a 20% cushion. So at a very minimum, if I lost 20% of my income, that property should still take care of itself and pay back the equity. That's where I'm at. So obviously I've had to pass on a lot of deals in the last year because many of the deals wouldn't cover the debt service, much less the equity with a 20% vacancy, economic occupancy or vacancy. So that's at a high level, the things that I look at. And it's real important to verify that occupancy in this climate and find out who's current, who's not, who's going to have a problem.
Right. A lot of great information in that, Greg. You talked about all these steps that you take. Do you have a checklist? And if so, like what is it on like Excel or any other software?
Yeah, so it's just a checklist that I've developed over the years, and simple Word document. You can pull it out on your phone and go through it. I mean, I pretty much know now. I don't really need one, but I do have it. I mean, I've got systems in place for everything in the business, which is just a simple checklist. There are softwares you can use, property management softwares that have due diligence checklists, and things like that. But I've been doing it so long, it's all up here.
And you mentioned an analysis software. What tools are you using for that?
So there's something out there called Enodo, Enodo, and that gives you Walker and Dunlop information, and it shows you properties all across the country, so you can compare rents, operating costs, things like that. It's also got an underwriting tool, so you can upload rent rolls. It automatically populates it. So that's a real robust system. And then if you're using a investor management system like IMS, they just bought out a company last year or earlier this year. I can't remember. It's an asset management component, and that's got a lot of the due diligence checklists and things like that built in for asset management. So there's some really good tools out there that automate the entire process.
Nice. Have you ever been burned on due diligence before? And if so, like what was the thing that you missed and what happened?
No, I've never really, well, I guess, probably the biggest thing is finding, on some older properties like underground tanks or something like that you didn't know about, or even in commercial. I went to renovate a building. We tore the slab up and there was a hydraulic lift buried that they just covered and filled in. So obviously there's going to be things like that especially when you're buying. I do a lot of adaptive reuse, so I'll buy a warehouse and redo it. So on something like that, there's just no way you can know. You're not going to dig up a slab, and if the environmental doesn't pick it up, you're not going to know what it is. But on a multifamily, no, I've never missed anything. I mean, it's pretty straightforward. There really aren't any surprises if you take the time to do everything, which is go into all the units, make sure you or somebody on your team sets foot in every single unit, checks every single thing, shake the toilets, shake the sinks, make sure the water's working. When your inspector goes through it, they're going to check everything, all the outlets, all that kind of stuff. So I haven't really seen too many surprises there.
All right. Have you ever had a retrade, and what did that look like? Working with the broker and the seller.
I don't deal with that a lot. I'm an easy buyer, and I know what I'm doing, so I can identify stuff pretty quick. I know what things are going to cost. It's very rare that the inspection report's going to pick up anything significant that I didn't see on the initial inspection. Again, I started my career as a builder, so I've built the buildings, I've renovated them, so I know exactly what I'm doing, exactly what I'm looking for, and exactly what things are going to cost. So I do all that beforehand. So I find everything I can, and I don't beat the seller up. I just say, hey, the pool's going to cost $100,000. The roof's going to cost $350,000. Hey, these doors are $400 a piece. So I go through all that on the front end, and then if I find something that's within 1%, I don't really mess with that. But if there's something that pops up that I didn't see, which hasn't really happened yet, I would go back and talk to the seller about it and try to get some concessions there. But if it's a $10 million deal and you're talking about, $20,000, $50,000, you don't want to mess with that.
Right. Understood. How many days does it take you to do due diligence, and how many days, if it differs, do you put in the contract?
So I like to write my personal contracts, for multifamily acquisitions, at least 60 days due diligence, 90-day close. Now that changed, in the last year because it got so competitive. People were doing 30 and 30 or 30 and 45. And to be competitive, you had to do that. But depending on the property, if it's pretty straightforward, newer property, I like, nicer properties, you can shorten that due diligence time frame. But moving forward right now, man, you need 90 days due diligence, almost 120 to 180 days to close because the lenders are getting backed up, inspectors, are getting back up, all bets are off, in terms of how long it's going to take. No more hard, earnest money. You don't want to do that anymore. You got to give yourself time, and you got to give yourself an out. You got to have your force majeure, coronavirus clauses now, for anything that could pop up. So retrading is back on the table. No more hard earnest money, and give yourself plenty of time to close. Land development and other things, a whole different story.
Really good advice. Kyle, you want to take it away?
Yeah, let's do it. All right, Greg, what is your asset management superpower?
So probably being able to look at things from a risk standpoint and be able to foresee the unforeseeable and hedge, things that could arise. And then construction costs. I know construction costs.
Perfect. And so you mentioned that you typically did due diligence for 60 days. Can you tell the listeners what's the main reason for that? Because when you walk the units, you can walk them in a couple of days. You can do lease audits in a couple of days. What's kind of the one or two things that's going to take the 60 days to get through your due diligence?
You just never know. Things can happen. So somebody, inspector can't show up, a survey doesn't come back. I just always like to allow plenty of time on a large commercial property. I mean, appraisals, all that that's all part of the process, right? So your loan docs, everything is kind of part of that due diligence process as you're kind of going along. So I always like to add and allow for a little bit more time. A lot of people, don't think you can get 60 days. If you don't ask, you don't have, right? Or you don't get. So I always like to allow, again, I'm very conservative. I know the things that can go wrong and things that can happen. And I want to give everybody plenty of time to travel, plenty of time to get stuff done and not be pressured. And you're raising capital, you're doing all these other things along the way. So, I just like to give myself more time. Land development, I'll tie land up for, 6 months to a year just for due diligence. And then I'll have an unlimited amount of time to close until we get all the entitlements and improvements. So I like long due diligence time, time frames and as much time as I can have to close.
Awesome. Well, thanks, Greg, for coming on the show and adding value on the subject of due diligence. So today we covered different things like starting your due diligence and underwriting and asset evaluation. Make sure you drive the local area, not just looking at it on maps, and then build systems to improve your due diligence process to make sure that's all online. So, Greg, can you tell our listeners where they can find out more about you?
Yeah, so gregdickerson.com, that's my website. All of my information's on there. And I've got YouTube channel podcast as well with a lot of great information. I make videos all the time talking about due diligence process, development, all types of different properties. So I build, develop, buy, and sell all kinds of different types of commercial and multifamily real estate. So gregdickerson.com.
Awesome. And to our listeners, thanks for listening in. If you do like this episode, please head over to iTunes and Stitcher, like, subscribe, and review, as that'll help us grow our audience. And we'll talk to you next week.